Hello, and welcome to Portfolio Matters Weekly Update, week 124. But before I get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Full disclaimer can be found at the end. Okay, before we get going, a couple of housekeeping items. First of all, on Wednesday, we'll be having a live Discord chat with Rogue Trader at 7:30 p.m. I hope to see a few of you there. There is a lot to talk about. It's a very interesting and frankly confounding period in the markets. Also, I have been away for 2 weeks and I was hiking with friends, many of whom were viewers of the podcast, and they had several suggestions on how to improve the podcast. In particular, we currently go through the data and then go through the charts, and that creates some duplication. So from next week, we'll be changing things so that we will just be going through the charts. And as we go through the charts, we'll be going through the data simultaneously. So we won't be duplicating the discussion. But that will require quite a lot of setting up, and I hope to go live with that next week. Okay, news in the last 2 weeks. Well, I've had this strange situation in Russia where the Russian mercenary leader, Evgeny Prigozhin, has staged an abortive coup attempt, or so it seemed, marching towards Moscow and taking over Rostov before reaching a deal with Putin and agreeing to leave Russia for Belarus. But apparently he hasn't left Russia for Belarus. He's somewhere in Russia. So who knows what's going on. In the markets, US GDP was revised upwards for Q1 to 2.0%. And the US economy seems to be doing just fine. We had ADP employment data for June, and that came in very hot. That came in at 497,000 jobs created, massively beating expectations. And the Dallas Fed governor, Lori Logan, then said on Thursday that she supported a July rate hike to cool what appeared to be a red-hot economy. But we then had non-farm payrolls, and they came in weak at only 209,000 jobs created in June, with negative revisions to the April and May numbers, which were revised down by a total of 110,000. So some contradictory employment data there. We have a special section on non-farm payrolls coming up. So some charts related to the news. Well, last couple of weeks have seen a continued sell-off in UK government bonds. And if you back out of the bond prices, the interest rate expectations, you get the markets now expecting UK interest rates to hit 6.5%. Now, I think that's misleading, and the Bank of England has simply lost control of the yield curve. I don't think UK base rates will hit 6.5%. In the US, the markets are expecting terminal rates of around 5.4%. Reminder, your Fed's rate is at 5%, so that's between 1 and 2 further rate rises. Now, in France, there have been riots after the police shot a North African teenager who refused to stop at a checkpoint. And this is an interesting chart from Andreas Stino Larsen, which shows food consumption in France. Now, in previous weeks, we have shown that French grocery prices are by far the highest in Europe, and high inflation in France has caused a big drop in food consumption. So French citizens are eating less and clearly unhappy. And was that a contributory factor to the riots? Okay, and on to this week's economic data. Now, reminder, going forwards, we're going to be getting rid of the tables, and we're just going to be going through the charts, and I will include the data on the charts, so we only discuss it once. And I will be consulting Discord members on the best format in which to do that during the week. And I should also say that there's a lot of data this week, as we have 2 weeks worth. Okay, so first of all, UK CBI Distributive Trades Index, which covers the retail sector, is expecting at 0 in June. It came in at -9, a bit better than May, but not by much. The UK retail sector is not doing well. UK mortgage approvals for May were up on April and slightly ahead of expectations. Mortgage lending was better than expectations, but still negative. More people are repaying their mortgages than taking out new ones. Consumer credit came in weak in May at 1.14 billion, down on April and below expectations, as did net lending to individuals. UK car production was very strong in May. It was expected at 12% year on year. It came in at 27%. So the UK car manufacturing industry is doing well. Had nationwide house prices for June, and they were better than expected, but still negative. House prices are falling at their fastest rate in over a decade, at -3.5% year on year. New car sales defied the slowdown in consumer spending and rising interest rates, rising by an enormous 26% year on year in June, massively beating expectations. And that reveals that the UK consumer is still strong and still has the confidence to spend on large durable goods purchases. However, UK construction fell into contraction territory in June for the first time. So finally, higher rates are impacting construction. And reminder, construction and manufacturing lead the economy into recession, and both of those are negative. And the BBA mortgage rate followed bond yields higher in June. It rose from May to 7.5%, and yields continue to rise. And I suspect the July number will be even higher. Okay, moving on to the EU, we had the Eurostat surveys over the last couple of weeks, and economic sentiment weakened again in June, below expectations and down on May. Industrial sentiment fell further to -7.2, below expectations and well down on May. The good news is manufacturers' selling price expectations also massively missed expectations. And so price pressures in the Eurozone are weakening. We have more data on that to come. Services sentiment was better than expected, but still way down on May. And so the service sector also seems to be weakening. Consumer confidence was -16.1, which was better than May and met expectations. Consumer inflation expectations fell in June from May and were lower than analysts had forecast. So that is very good news. We also had CPI numbers, which were reassuring. CPI came in at 5.5% for the Eurozone in June, well down on May and slightly below expectations. Month on month, it met expectations. Core CPI also was better than expectations, but rose in June from May to 5.4%. So the good news is that inflation is missing forecasts. So it's underperforming forecasts, which is a good thing, but core is persistent and much higher than the ECB would like. Producer price inflation for May was negative for the second month on month. So it came in at -1.9% in May, which was lower than expectations. Year on year, it came in at -1.5%. Again, better than expectations. So producer prices are now in deflation territory in the Eurozone. And finally, the construction PMI fell further in June and is now firmly in contraction territory. So Again, in the Eurozone, the manufacturing and the construction sectors are both in recession, and they are the two sectors that tend to lead the economy. Then we had Chinese PMIs. So we had both the Caixin and the NBS PMIs, and they all painted a picture of a weakening manufacturing sector and a sharply weakening non-manufacturing sector, albeit the non-manufacturing sector is still in expansion territory. So the economy overall is still growing, but that growth is weakening. Pause, take a look. Finally, on to the US. Now, we had durable goods orders for May, and they massively beat expectations. The expectation was they'd fall 1.0% month on month. Actually, they rose by 1.7%, reassuring for the US economy. House prices continued to defy rising interest rates, rising 1.7% month on month, beating expectations, and year on year down just 1.7%, again beating expectations. New home sales in May also beat expectations at 763,000 annualized, compared to 680,000 in April. Month on month, sales rose 12.2%, massively beating expectations. The expectation was that there would be a fall in new home sales. The problem in the US is that existing homeowners all have very long-term, low-interest rate mortgages, and they're unwilling to move because they'd have to give up their very low mortgage rates. Therefore, there are few existing homes for sale, and home buyers are having to buy new homes, which is supporting the house builders. And so new home sales are outperforming expectations. Pending home sales have fallen sharply. So pending home sales in May missed expectations, on down 2.7% month on month, and they're down 22% on the year, again missing expectations. Personal income for May was 0.4% month on month, and that beat expectations, although the April number was revised down to 0.3 from 0.4% previously. Personal spending missed expectations, coming in at 0.1% month on month, which suggests consumers in the US were more cautious in May. PCE inflation in the US came in at 3.8% year on year, down on April and below expectations. So like in the Eurozone, inflation is falling and is now coming in lower than expectations. Core PCE inflation also beat expectations at 4.6%, but is still way too high and was down only 0.1% from April. We then had the ISM manufacturing PMIs, and that wasn't great. In June, it came in at 46, below expectations and down on May. The manufacturing sector everywhere continues to decline. Employment fell into contraction at 48.1, missing expectations. The good news is that prices paid fell sharply to 41.8. So like in the Eurozone, US manufacturers are seeing deflation. New orders recovered a bit at 45.6, beating expectations and up on May. Construction spending in May came in at 0.9%, beating expectations, and was up on April, although the April number was revised down. It had been 1.2%, it was revised down to 0.4%. But construction spending in the US continues to defy gravity and is doing just fine. Factory orders in May were flat and below expectations. But just like in the UK, vehicle sales holding up extremely well in June, an annualized 15.7 million cars were sold. That number is up on May and beat expectations. So the US consumer, like the UK consumer, is still prepared to spend on big durable goods. Then we had the challenge of job cuts numbers. Job cuts were expected to rise to 103,000 in June. They actually fell to 41,000. So employers did not increase layoffs. In fact, they reduced layoffs. We then had the ADP employment change for June, and that number was absolutely astonishing. It was expected at 228,000. It came in at 497,000 net jobs created, although the May number was revised down by 21, although the May number was revised down by 11,000. So according to the ADP employment report, the US jobs market is red hot. We then had ISM services data. Services bounced in June, beating expectations, coming in at 53.9, and that was up on May. Employment rose, went back into expansion territory, massively beating expectations. Business activity surged to 59.2, massively beating expectations and well up on May. Prices paid was higher than expected, but still down on May. So again, inflationary pressures in the services sector are fading. New orders bounced from May, but came in below expectations. Non-farm payrolls, which came out on Friday, painted a contradictory picture to the ADP numbers. June non-farm payrolls came in at 209, below expectations and well down on May. And the figures for the past 5 months were also revised lower. And the April and May numbers were revised down by collective 110,000. So the US jobs market, according to the non-farm payrolls, definitely appears to be weakening. We have a special section on that coming up. The unemployment rate, though, fell to 3.6%, back towards its lows. The participation rate was flat, and hourly wages, unfortunately, beat expectations. And the May number was also revised up. So wage growth continues to be too hot for the Fed's liking. Average weekly hours worked also rose. So the June numbers portray a US jobs market that is tight and active. Okay, so we also had some quarterly data, and the highlight was that US GDP in Q1 was revised sharply higher, coming in at 2% against expectations of 1.4%. So the US economy seems to be doing just fine this year against my personal expectations, as we've discussed many times on the podcast. Also of interest was corporate profits, which came in at minus 5.9% in Q1. So the national accounts data is showing that corporate profits fell sharply. Now, we know that actually earnings per share in the S&P 500 rose decently, but the earnings per share numbers for the S&P 500 were flattered by the fact that share buybacks have reduced the numbers of shares in issue. Corporate profits in aggregate are falling, as you would expect, given that we know US companies are hoarding labor and growth is slowing. Okay, on to the charts. So this is UK distributive trades, and that continues to be negative. Mortgage approvals are low, as you would expect, given very high interest rates, which are still rising. Mortgage lending is going nowhere. UK house prices are the worst they've been in many years, down 3.5% year on year and falling. And this is a chart from the FT, and it shows that UK home sellers are having to accept discounts on their asking prices. The pink line is the number accepting discounts over 10%. The blue line is over 5%. Thank you to Wayne J for that chart. UK consumer credit, actually, that looks pretty decent. Lending to individuals, though, is very weak. Reminder, that includes mortgages. UK car production, surprisingly strong, although it has not recovered to its pre-pandemic levels. New car sales surged and look good, but mortgage rates continues to rise as the bond market loses confidence in the UK and the Bank of England's ability to control inflation. And interest rates throughout the economy are rising quickly, and that should slow the economy. The construction sector fell back into contraction territory. Moving on to the EU, economic sentiment fell further in June. Industrial sentiment is particularly bad and hit a new low. But the good news is EU manufacturers' selling price expectations are back within target range. Services sentiment fell in June from May, and the services sector is weakening once again. EU CPI is falling. Month on month, it was up 0.3% in June. Core CPI, though, remains elevated and bounced in June. The ECB is likely to continue raising rates. PPI, though, was negative. So producer price inflation has come full circle and is back down negative. And that suggests that EU inflation has just been a one-off price surge caused by the war in Ukraine and the surge in energy prices and food prices. The unemployment rate remains at its lows, so EU labour markets are tight. The good news is inflation expectations are falling rapidly. Eurozone construction sector is not doing very well. It has been below 50 for over a year now. Okay, moving on to the US. Well, this is GDP quarter on quarter analyzed, which came in at 2% in Q1. Corporate profits fell sharply. These are in absolute numbers, in billions. Consumer spending looks absolutely fine. PCE prices are down from their peak, but not coming down as fast as the Fed would like. And core PCE prices are not coming down much at all. The Fed will need to keep rates higher for longer to get inflation under control. Now, this is the ADP employment change for June and is the highest in a year, a really astonishing number. Now, part of the cause of the discrepancy between the ADP numbers and the non-farm payrolls is the fact that people are giving up working for themselves and moving into paid employment. So what's happening is that, say, online tutors who work for themselves are giving up and actually becoming paid teachers. And if you look at a breakdown of the ADP jobs report, you'll see that a lot of the new jobs were low-paying jobs in leisure and hospitality, and that the manufacturing sector is, as you would expect, losing jobs. The construction sector, though, continues to add jobs, and that is traditionally the sector that leads the economy into recession. This is non-farm payrolls, and the June number was weak, and I think you can see a general downwards trend. So the labour market is slowing, but the unemployment rate remains very low. The labor market in the US is tight. Average hourly earnings are not falling, remain too high for the Fed's liking. Hours worked bounced back up, suggesting improving activity in June. PCE inflation is coming down quickly, but core PCE inflation is not. And that is what is going to concern the Fed, and they're likely to have to keep interest rates higher for longer. This is a month-on-month number. Personal income is a problem. That is too high, 0.4% month-on-month, although month-on-month spending fell, suggesting increased savings. Total vehicle sales, that is a strong number. So suggests the US consumer has still got money to spend. Manufacturing PMI continue to fall, and all the components of the ISM manufacturing PMI were negative, and that is a very rare occurrence as is normally associated with recessions. And manufacturing employment ticked back into negative territory, but is nowhere near as low as you would expect from the headline number. Manufacturers are hoarding employees. Prices paid continue to fall, and that is good news. New orders bounce back up, but remain in contraction territory. Some good news was that the manufacturing new orders bounced while customers' inventories fell below 50. So at some stage, customers will need to restock, and then they will have to reorder from manufacturers, and new orders should bounce back. Services PMI bounced strongly in June. So service sector seems to be doing okay in the US, and employment rose, and that is a good number. Business activity surged strongly. And so in June, it looks like the US services sector was doing just fine. Prices paid continued to fall, and that's good news. New orders bounced back, but not by that much, and not by as much as you might expect given the surge in business activity. Factory orders were lower than expected, but positive. The Dallas Fed's manufacturing index bounced a bit, but is still firmly in contraction territory. The Richmond Fed also bounced a bit, but is also in contraction territory. The Chicago PMI, which looks at general business activity in the Chicago area, bounced a little bit, but is still firmly in contraction territory. Durable goods orders were good. House prices month on month continue to defy gravity and were decently positive for the third month in a row. Year on year, though, house prices are falling. New home sales are astonishing, rising strongly in May, and those are actually good numbers compared to history. So somehow US consumers are finding ways to buy new homes despite very high mortgage rates. And month on month, there's an astonishing surge of 12.2% in new home sales in May. Pending home sales, though, fell as there are fewer existing homes for sale. Challenger job cuts, well, surprisingly, in June, US companies reduced their layoffs. Now, this is the US MBA 30-year mortgage rate, which is stable around 7%. There's very little mortgage activity. New home sales year on year. Construction spending month on month, that looks all right, actually, 0.9%. So the US construction industry continues to do okay, despite very high interest rates. The Red Book retail sales has fallen a long way, but is resisting going below zero. The Logistics Managers Index, however, is at a new low. So goods moving around the country. There's low activity. So JOLTS job openings down from its highs, but there's still a lot of jobs available. And the quits rate actually rose in June, suggesting that US workers are more confident about leaving their jobs because they can find alternative work. Initial jobless claims bounced back a bit last week, but is still not elevated, and continuing claims are slowly declining, suggesting that unemployed people in the US can find new work. Now, recessions were a decline in economic activity, and so although jobless claims remain low by historic standards, they are up almost 40% from their lows, and that tends to be associated with a coming recession. Okay, moving on to China finally. This is the manufacturing PMI, improved a bit, but still in contraction territory. The NBS non-manufacturing PMI fell. So that means the general PMI shows that the Chinese economy is still growing, but that growth is fading. Caixin manufacturing PMI, in contrast, the NBS PMI, shows that the manufacturing sector in China is expanding, but the expansion is slowing. They agreed that services activity slowed sharply in June. Okay, so in summary, for the UK retail trade continues to do poorly, as reflected in the negative CBI distributive trades index. Consumer credit is weak. UK house prices are falling. Construction sector activity fell back into contraction. But new car sales surged, suggesting the UK consumer still remains strong. So the UK economy does appear to be slowing. The manufacturing sector is certainly in recession, and the construction sector is slowing. UK interest rates continue to rise and rise sharply. Against that backdrop, I think a recession seems inevitable. In the EU industrial and services sentiment both fell further in June. Industrial sentiment has been negative for a while now. Services sentiment is positive but weakening. The good news is inflation expectations have fallen sharply, and inflation came in below expectations, but core inflation remains elevated, and the ECB is going to have to keep on increasing rates despite a slowing economy. In China, manufacturing was weak and weakening in June, and the services sector, which is growing, weakened sharply. So the Chinese economy is growing, but that growth is slowing, and China will not come to the rescue of the world economy. Finally, the US. The US economy continues to show resilience. GDP in Q1 came in at 2.0%, which is perfectly decent. Services activity rebounded strongly in June, and the ADP employment survey showed astonishingly strong employment growth. New home sales are strong. New vehicle sales were strong. The unemployment rate remains at its low of 3.6%. Having said all that, non-farm payrolls was weak, and previous data was revised lower. So the economy, the jobs market does appear to be slowing. Inflation is weakening, but core inflation remains persistent and too high for the Fed's liking. Interest rates have not peaked. They're still rising. The market is expecting between 1 and 2 further Fed rate hikes. And the US economy faces further headwinds in Q2 from the negative credit impulse and the restart of student loan payments. I continue to believe that the US economy is likely to weaken into a recession in the second half. Although the indications so far are that the recession is likely to be shallow. Okay, on to one chart. And this shows how the Fed behaved the last time there were inflationary episodes. And the green line shows the rise in interest rates in the 1981 cycle, and the blue line shows in the 1988 cycle. And what they show is once interest rates rose, they stayed high for a long period of time. The x-axis is quarters are following the inflation shock. And you'll see that interest rates stayed high between 12 and 15 quarters, i.e. 4 years. So expect interest rates to stay high unless the economy goes into a sharp recession. Okay, and onto non-farm payrolls. Well, the streak is over. Finally, non-farm payrolls missed expectations. Although, if the actual numbers reported at the time had reflected the revised numbers, that streak would not have been as long as it has been. And so the Bureau of Labor Statistics has revised lower every non-farm payrolls this year. And we've talked about this before, but revisions to non-farm payrolls are themselves a forecaster of economic conditions, and negative revisions tend to forecast a slowing economy. If we look at breakdown of non-farm payrolls, you'll see that the majority of the jobs were either government, and that's the yellow bars, or they were in education and health services. Government was responsible for 60,000 of the 209,000 jobs created. And if you look at a breakdown of the jobs growth by category, you'll see that cyclical jobs are falling towards recession, and growth in non-cyclical jobs is slowing. What is supporting jobs growth is the government. So jobs created in June were 209,000, but the number of multiple job holders increased by 233,000. So the whole of the increase in employment can be explained by increase in government jobs plus increase in people working more than one job. So actually the headline number disguises some underlying weakness. And if we look at the number of temporary workers, they continue to decline. Reminder, temporary workers are the easiest to get rid of. But the jobs market remains tight. There are around 1.6 job openings per unemployed person. And so the rise in multiple jobs is partly explained by the fact that unemployment is very low and companies can't get the staff. The only people available to be hired are people who already have an existing job. Now, there's a big difference between the ADP numbers and the non-farm payrolls, and this chart compares the two. And you'll see they are correlated, but can differ very substantially month on month. The ADP numbers are very volatile. Employment is the last economic variable to decline as the economy slows, and based on the inversion of the yield curve, we'd expect employment in the US to start rolling over around October. So watch this space. So in summary, surprisingly weak non-farm payrolls report that contradicts the strength of the ADP report. The ADP report reported an enormous 497,000 increase in payrolls in June compared to non-farm payrolls of only 209,000, almost all of which were either increase in multiple jobs holders or government workers. We also revised down the historic non-farm payrolls for April and May. So The non-farm payrolls is portraying a US jobs market that is weakening. It's tight, but it is slowly weakening. And on to student debt. Now, in the last 2 weeks, the US Supreme Court has ruled that Biden's student debt forgiveness plan was unlawful, and student debt repayments will resume 60 days after the 30th of June, i.e. towards the end of August and early September. And that will equate to fiscal tightening and will be a drag on consumer spending later in the year. 27 million Americans have student loans, and they have on average monthly payments of $417. Unsurprisingly, the lowest paid workers will be most affected, and they are the ones who are struggling to make their loan repayments. So in summary, starting in September, fiscal conditions tighten. In essence, taxes rise for 27 million workers with existing student loans. That will add to recessionary pressures. Reminder, US interest rates have not peaked and they operate with a lag. On to credit crisis watch. So over the last 2 weeks, there has been no recovery in US regional banks, and we seem to have forgotten this, but 2023 has seen the second, third, and fourth largest bank failures in US history, and the underlying causes of those bank failures, i.e. the decline in banking profitability by the rise in short-term rates, has not gone away. Bank deposits have flowed back into the US banking system over the last couple of weeks, but not to any great extent. Loan growth is weak, particularly for commercial and industrial companies, and that means the credit impulse will be highly negative. High-yield corporate bond issuers face an increase in their interest payments of about 80% as they come to refinance, and a lot of them are going to have to refinance over the coming years. So this year, not many need to refinance, but next year and the year after, increasing numbers do. This will be a slow burn crisis for highly indebted US corporations. We also know that lots of US small banks have large exposures to commercial mortgage-backed securities, and particularly in the office space, there's rising delinquency rate. A Bloomberg article this week was saying that Scott Reckler, the chief executive officer of real estate giant RXR and a Federal Reserve board member for New York, was predicting that between 500 to 1,000 smaller banks could disappear because of insolvency or consolidation this year. And bankruptcy filings continue to rise, although the financial markets do not seem particularly stressed about that. Now, we know US money supply growth is negative. And if you look back at history, negative M2 is a rare occurrence and is associated with tightening economic conditions and generally leads to some sort of financial crisis. Going back to my chart, I think that we are somewhere around here. We've had the initial crisis, but as conditions seem to have normalized, everyone has forgotten about it. But meanwhile, in the background, the crisis is bubbling away, and as commercial real estate loans come to be refinanced, losses will need to be taken, and further crises, further bank failures are inevitable later in the year. US regional banks hold $2.3 trillion in commercial real estate debt. As that is refinanced, so losses will be crystallized and further bank failures appear inevitable. Okay, on to inflation watch. So we had numbers from the EU for June over the last couple of weeks. So EU CPI fell to 5.5%, but core CPI ticked up again to 5.4%, although that was below expectations. The FOMC meets on the 25th, 26th of this month, and the ECB on the 27th. And markets are currently expecting both to raise interest rates. But if we step back, inflation has peaked. It is coming down, although core inflation remains elevated. And if you're going to think about one chart this week, it's this one. The blue line is PCE inflation. The red line is worker compensation. Essentially, inflation is a function of wages. Unless the Fed can create some slack in the labor market and bring down wage inflation, it will not bring inflation under control. And US labor productivity is negative. So in the US, you have high wage growth, but low and declining productivity. So the real wages faced by businesses are higher than the headline suggests. But the good news is wage inflation is slowing, but slowing slowly and remains too high for the Fed's comfort. And companies appear to be hoarding labor. The light blue line is the earnings outlook for US small companies. The dark blue line is the number increasing employment. And you'll see, historically, there's been a good link. But during the pandemic, US companies laid people off and then found it difficult to rehire them. And this time, they're hoarding labor. That will reduce corporate earnings, but support the economy. The thing is, if that changes and other companies start to shed jobs, then other companies have less incentive to hoard labor. So you could see this change very rapidly. The UK has a big problem. This is wage growth year on year, and you'll see in the Eurozone and the US, it is falling sharply. In the UK, it is still rising, and it is still rising in part because in April, the government mandated a 9.7% rise in the minimum wage, and that is slowly feeding through to job adverts. So the UK has mandated wage inflation, and the Bank of England's survey of businesses confirms that they are seeing strong and rising wage growth. Returning to the US, the Cleveland Fed's inflation model is forecasting that both CPI and core CPI will rise in July, and so that puts more pressure on the Fed. The core CPI figure, which is the orange line, is too high, and that rise in July should confirm the Fed in its decision to raise rates again in July. So this chart shows that there is a strong correlation between the ISM Services Paid Index and services inflation with a lag of 6 to 8 months. And if that relationship continues, services inflation in the US should fall to below 2% towards the end of the year. So that's good news. In the EU, PPI is negative. Now, if the traditional relationship with CPI holds, then you would hope that European CPI will fall back towards zero rapidly. However, I would note that if you look back through time, there is no simple relationship between PPI and CPI. So before and after the great financial crisis, CPI actually led PPI. This time round, we are hoping that PPI is leading CPI. What appears to be true is that the two do not peak that far apart from each other. So hopefully these very low PPI numbers should mean that CPI comes down further in the coming months. Now, in the US, the AMP pipeline inflation indicator, which looks at commodity prices and their effect on future inflation, is forecasting that US CPI should continue to fall in the coming months. And manufacturing conditions and prices have gone from inflationary to deflationary. So goods inflation should be negative and a negative contributor to future inflation. US rental inflation continues to fall, and new home prices in the US are falling. So we know that new home sales have been strong, but home builders have achieved that by cutting prices. They're down 16% from their peak. US true-flation is at 2.5%, where it appears to have stabilized, and that is well below the US headline inflation. In the UK, true-flation is declining, but it's still way too high at 11.44%, well above headline inflation of 8.7%. The good news is that Kantar are reporting that grocery price inflation has peaked and came in at 16.5% in June, which is good news, but is still very high. But since then, Tesco have cut the price of 500 everyday items, some of them quite substantially. Milk prices now down 20% from April, and that is not disinflation, that is deflation, that is negative changes. And so hopefully UK food inflation should now start to fall quickly. Although, and thank you to Simon W. for sending this, headline price cuts do not necessarily mean deflation, because manufacturers also adjust the size of their offerings. Now, if we look at UK broad money growth, in May, it was minus 3.8 billion. And if you follow Milton Friedman in believing that inflation is always and everywhere a monetary phenomenon, then UK inflation should now start to fall rapidly. And UK business lending is weak, suggesting that monetary velocity is also slowing. So in summary, everywhere inflation has peaked. Goods inflation is weak and weakening, but labor markets are tight and core inflation is too high everywhere, particularly in the UK, where the recent rise in the minimum wage essentially mandates inflation. So central banks are going to have to keep on tightening until they slow the economy and create some slack in labor markets. And on to recession watch. Well, the US yield curve continues to forecast a recession, but we saw that in Q1, US GDP came in at 2%, and the Atlanta Fed's GDP now estimate for Q2 shows that GDP was just fine, coming in at around 2%. Reminder, Q2 is now over. LinkedIn are saying that their hiring rates have stabilized around normal levels. So they're saying that the labor market is no longer red hot. It's around normal, but it's not really contracting. And the fundamental problem for the US economy is that the participation rate is back above pre-pandemic levels. So where are the new workers going to come from? The economy is running out of spare capacity. But the US economy continues to surprise. The Citigroup Economic Surprise Index is decently positive for the US, whereas for China and the EU, it is negative. The EU economy is slowing, and as is the Chinese economy. Everywhere in the developed world, though, manufacturing PMIs are negative. And in the EU, they're really bad. So top left, we have Germany. Black lines are PMIs. The dotted blue lines are new orders, both of which are very negative. Same in Italy, same in Austria. Austria is really bad, actually. And also in the Netherlands. And if you look at energy-intensive industries, they look particularly bad. So energy-intensive industries in Germany have not recovered from the energy shock, even though energy prices have fallen sharply since then. This is Taiwanese export orders, which are a good proxy for global trade. They hit new lows in June. Global trade is not doing well, and that's reflected in falling export orders globally. US factory orders were down 1% year on year in June, and core factory orders fell for the fourth straight month and down 4.2% year on year. Not good. And the fall in factory orders would normally have resulted in a recession by now, as you can see from this chart. The vertical grey lines are recessions, and the fall in goods demand is reflected in falling transport activity. This is the US Cass Truckload Line Haul Index, which is down strongly year on year. Now, one thing we've discussed before is excess savings in the US. Now there are a wide range of estimates when the US excess savings will be exhausted. According to this chart, excess savings should be gone between September 2023 and June 2024. So headwinds for the US economy are rising. The Fed believes that those excess savings have already been exhausted. The black line is the US. But Bank of America disagrees, even on its most optimistic estimate, whereby the US returns to its February 2020 savings rate. It still thinks there are excess savings on aggregate. Of course, much depends on the distribution of those savings. If those savings now all belong to the rich who have a lower marginal propensity to spend, then they won't have much effect on the economy. And if the US consumer still has excess savings, then how come delinquency rates are surging, and surging actually quite quickly for people of working age, i.e. people in their 20s, 30s, 40s, and 50s. Unsurprisingly, delinquency rates for the elderly on the pension, and frankly, who don't spend much, have not risen much. Savings rates remain fairly low, but are rising as those pandemic savings are depleted. Now, we know that construction activity in the US has been supported by reshoring of manufacturing jobs and a huge increase in investment in primarily the semiconductor sector in the US, as the US attempts to build its home supply chain for semiconductors. Now, this is total construction spending by manufacturers in the US, and it has surged, but you'll notice that surge seems to be slowing. So, has construction spending peaked? And in which case, you would think that construction growth will slow and the construction sector is a primary driver of the economy and leads the economy into recession. And over the last few years, we know there have been a lot of people buying houses because they can make good money from Airbnb, better money than renting it out. Well, that trade appears to be over. Airbnb revenue has collapsed. And so those people may well have to start selling their homes in the coming months. And that will put more inventory on the market and should drive house prices lower. And the Fed is forecasting that the unemployment rate will rise in H2, even though they're not yet forecasting a recession. So the Fed is forecasting that it will create slack in the labor market, and that should bring inflation down. And turning to the UK, this is brick deliveries. Thank you to Wayne J for sending me this. And it shows that brick deliveries are well down over the last couple of years. And that suggests that home building activity is in decline, and that confirms the PMI data. You'll see here that housing PMIs are weak and falling, whereas the commercial and civil engineering have held up much better. But overall, construction activity in the UK is in decline. So in summary, the yield curve continues to forecast a coming recession. The Fed is forecasting that it will slow the labor market in the US, and that seems to me to suggest they think they will cause a recession, although we don't know how deep that recession will be. The global manufacturing sector is in recession, and global trade is in recession. Interest rates are rising, and that will continue to affect the economy with a lag. I continue to expect a recession later in the year. Onto other charts. Now, this is global temperatures, and I'm afraid this year is a record, and a big record. So we have not got global warming under control, and global temperatures are rising. Now, this chart shows the debt to GDP ratios of France and Germany, and they have diverged strongly. France has very high debt levels, and throughout the Eurozone, we have seen that there's hugely divergent inflation, for which the ECB has the task of imposing a single interest rate. And to my mind, the Eurozone crisis is not dead. It's just slumbering. And we don't know when it will next occur, but crises tend to occur during recessions. We know the ECB is still raising rates, and the Eurozone economy is slowing. So will the Eurozone crisis return in the coming couple of years? Thank you to all our Discord members who have been sending me stuff while I've been away and allow me to put this all together relatively quickly today. And this is from Tibster, and it shows the largest phosphate deposit in the world has been found in Norway, and it would be enough to satisfy world demand for 100 years. So that's potentially very good for fertilizer prices. You should also note that this deposit contains vanadium, and cheap supplies of vanadium would not be good for ferroalloy resources and bushveld minerals, both of which we have talked about previously. Now, moving on to China. China no longer receives foreign direct investment. In fact, it's been negative. Foreigners appear to have been taking their investments out of China over the last 3 quarters. That will be a drag on future economic growth, and I suspect is strongly driven by the Biden administration attempting to limit technology transfers. And Chinese new home sales are falling again, and falling quite sharply. So year on year, very negative in the last month. As we've talked about many times, the Chinese economy is heavily dependent on investment, and infrastructure, and construction investment, and new home sales falling means less investment, and growth in China is likely to weaken. Turning now to the energy transition. We have just had solar panels installed. And bad news for me is that because energy is difficult to store, when the wind blows and the sun is out, electricity prices everywhere tend to go negative, just as I would be exporting my puny amount of excess energy to the grid. Now, last week in Germany, one day ahead electricity prices hit minus 54 euros a megawatt hour. The trouble is, electricity is very difficult to store. And so when the wind blows and the sun's out, there's just too much electricity and nothing to do with it. And so you get paid basically to use it. So unless we can find a way of storing electricity cheaply, that will destroy the economics of future renewable projects. And after all that, you need some good news. And this is biochar that has been enriched with phosphates recovered from wastewater. Now, we know that farmers' runoff, which is phosphate rich, tends to cause algal blooms in rivers, and in the sea, they can cause massive algal blooms, which lead to dead zones. When those algal blooms die and then decay, they use up all the oxygen in a part of the sea. So particularly in the Gulf of Mexico, you can get very large dead areas in summer. Well, scientists have managed to recover those phosphates and then enrich biochar, which can be used as a fertilizer. Biochar is when you burn organic matter in a low oxygen environment and basically just create charcoal. You then enrich that charcoal with phosphates, put it back in the soil, and you have a loop. And that stops the algal blooms and saves on fertilizer, which is all good news. Sadly, it's somewhere away from commercialization, but we can do it. Okay, and on to equity markets, and generally a poor week for equity markets, particularly for the all share, down 2.5%, Stocks Europe down 1.3%, S&P 500 down 1% over the last couple of weeks, but still up 13% on the year. The Nasdaq continues to defy gravity, up 0.2% over the last couple of weeks and up 30% on the year. Hang Seng, reflecting Chinese economic weakness, down 2.8% over the last couple of weeks, down 7.2% year to date. Topics down 0.4%, up almost 20%. Bitcoin continues to fly, up 1.1%, up 83% year to date. Sterling remains strong, up a further 1.1%, up 6.1% compared to the dollar this year. The euro also strengthened 1%, is up 2.4% compared to the dollar. Dollar index fell 0.7%, is down 1.2% on the year. The VIX rose sharply, but still remains very low at 14.8. Now, the stock market has confounded absolutely everyone this year. This chart shows that at the start of the year, analysts were forecasting that the stock market would fall in 2023. But obviously, it hasn't done so. So the market has defied absolutely everyone. And the Nasdaq is up the best part of 31% in the first half, and that is its best performance since 1983. But it's been a very strange year. The Nasdaq, which is very tech dominant, has done very well, but the rest of the market has done much less well. And healthcare, energy, and utilities are all negative on the year. We've had very strong sector differentiation, and Can that continue? Can the S&P continue just to be supported by a few technology stocks? In summary, the S&P 500 has been propped up just by the top 7 companies this year. The AI rally appears to have stalled. This is the performance of AI stocks relative to the S&P 500. Are they going to start coming back down to earth in the second half? And the S&P 500 has massively outperformed financial liquidity. So the red line is the S&P 500. The blue line is US financial liquidity. We've talked about this before and did a special podcast on that. If you're interested, please have a look. You'll see that generally the two are very well correlated, but recently the S&P 500 has defied falling liquidity. And if you look at things on a global scale, you'll see that the black line is total central bank assets, which have a very good correlation with the world equity markets, but equity markets recently have continued to go up while world financial liquidity has been falling. How long can that continue? Or has that correlation now completely broken down? And looking forwards, central banks are going to continue QT. So if the historic relationship holds, you would expect equity markets to have a tough second half of the year. But retail investors piled back into equities in June, and everyone's bullish again. In fact, the CNN Fear and Greed Index is now firmly in greed. And analysts are forecasting the S&P will rise by a further 9% over the next 12 months, even as dividend growth is slowing. But financial conditions remain tight in the US in that there are very few new IPOs. The UK, as you saw from the earlier table, has been poor this year and, according to Credit Suisse, is the most undervalued in the world. Not that that's much comfort to us. Now, quickly onto the great crash of 1929. And thank you very much to our Discord member, Jaw It, for sending me this, because this is fascinating. So this is 1928. And during 1928, the Fed raised rates from 3.5% to 6% and did QE, cutting its holdings of US Treasuries by 75%. Despite that, the Dow rallied by 87%. So these stock market rallies can be very hard to stop once the animal spirits get going. And we see that now in the NASDAQ, where everyone is extremely bullish and piling into AI stocks. But you can't defy the fundamentals forever. Eventually, the fundamentals assert themselves. And in the following years, that rally was more than unwound. And if we look at the fundamentals now, you'd expect growth companies which have most of their earnings far in the future, and you would expect to be highly sensitive to the discount rate, well, they have completely defied the discount rate. As interest rates have been rising, and that is the orange line inverted, so the NASDAQ has been off to the races. Traditionally, there's been a decent correlation between the two, as you would expect, but now NASDAQ has completely decoupled. I expect at some stage, and we don't know when, it to recouple painfully. And on to commodities and energy commodities. Well, oil bounced. So Brent was up 5.8% and WTI up 6.3% over the last 2 weeks. European natural gas prices faded back, down 2.6%, down 56% on the year. UK natural gas prices also fell 6% over the last couple of weeks, down 55% year to date. US natural gas prices eased back, down 1.5%, down 42% year to date. Coal bounced, up 12.7% over the last couple of weeks, but still down 64% year to date. Uranium having spiked is drifting off, down 1.4% over the last couple of weeks, still up 14% year to date, the only energy commodity that's up. Now, the reason that oil has had a bounce is that we've had strong economic data in the US, and we are seeing continued inventory draws. So the US oil market is currently undersupplied. Despite that, US crude production actually bounced back over the last couple of weeks, up 200,000 barrels to its highs for the year. The Baker Hughes rig count continues to fall. This is Brent, had a decent bounce. Now, this slightly blurry chart shows the PE ratios of Exxon and Chevron at the top, and they are almost double the PE ratios of Shell and BP. So the US oil majors trade at a big premium to the UK ones. The UK ones are cheap. And that can be explained in part because the US majors have been investing heavily in oil and gas and nothing in renewables, whereas the European ones have been switching into much lower yield renewables. But even there, the extent of the switch has been exaggerated. The vast majority of their investments remain in oil and gas, and that should be reassuring for investors in BP and Shell. These are EU natural gas futures, and they appear to have found a level way down from their peaks, less than 10% of their peaks. Same with the UK, US natural gas futures drifting off again. Coal had a bounce, but seems to be fading again in the last couple of days. Has that found a bottom? And uranium, having spiked sharply, is reverting. And on to industrial commodities. Well, generally a poor couple of weeks as Chinese economy seems to be slowing. Aluminium down 2.8%, down 9.8% for the year. Cobalt had a big bounce, but is still down 36% on the year. Copper drifting off, down 2.8%, down 1% for the year. Chromium drifting down. Iron ore also drifting off, down 0.9%, but only down 3.4% for the year. Lithium, having had that huge spike last year, down 42% for the year. Neodymium, also having had a big spike last year, down 7.3% over the last couple of weeks, down 40% this year. Nickel, very volatile, down 30% this year. Tin is the only commodity which is up this year. Heavily used in the semiconductor industry, up 4.5% over the last couple of weeks, up 15% year to date. Ferrovanadium had a bounce, up 4.7% over the last couple of weeks, down 9.5% year to date. And zinc down 20% year to date. This is aluminium, seems to be steadily drifting off. Cobalt has had a bounce. Copper not showing strength. Reminder that copper is needed for the energy transition, and we are structurally short of it. So in the long term, you'd expect to see the price of copper rising steadily, but we have some near-term weakness. Global copper inventories, and 2023 is the grey line, are low and falling, whereas the yellow line is the copper price, and you'd expect low copper inventories to support the copper price. This is chromium drifting off. Iron ore, it's had a bounce actually, but as we've seen Chinese construction fading again, you'd expect iron ore prices to start weakening once more. Lithium has had a decent bounce and seems to have found a level. Neodymium is drifting off again. Nickel seems to have stabilized towards its lows. Tin rising. Ferrovanadium, following iron, had a bounce of the last month. Zinc flat. Onto precious metals, and despite the rise in bond yields over the last couple of weeks, gold rose is up 5.5% year to date. Silver followed gold, bouncing 2.8% in the last 2 weeks, but it's down 3.6% year to date. Platinum continues to fade, down 1.6%, down 15% year to date. Rhodium had an absolutely catastrophic couple of weeks, down 32%. It is now down 67% year to date. We commented over the course of the last few months that rhodium has no bottom, as it's had this enormous spike on catalytic converter demand. And as the EV revolution gets going, you'd expect the decline in rhodium demand, and it's a very tight market. Small changes in demand can lead to huge price swings. Palladium also fell, down 3.3%, down 30% year to date. This is gold. Has that found a bottom? Silver, the same. Platinum has fallen a long way. Is that stabilizing? Rhodium, that looks awful. And has that now fallen to the level where it can bounce from? Palladium drifting off. On to rates. Well, in the UK, I'm afraid the Bank of England has lost the trust of bond markets, who are refusing to lend to the UK unless they get much higher bond yields. So for the 1 year, the last 2 weeks, the 1 year rate rose by 13 basis points, the 5 year by 28. These are big numbers. In fact, the whole yield curve shifted higher, and it's continuing to rise. Now, what's happening is that the market doesn't think the Bank of England has done enough to control inflation, and it is voting with its feet. And so it has tightened UK interest rates by itself, and that will slow the UK economy. And given the speed with which UK bond yields have risen over the last few months, fully expect that to start slowing the UK economy in the coming months. In the Eurozone, we also had a rise in interest rates over the last few weeks, actually quite substantial. Greek 10-year rose by 40 basis points, the Italian by 37. My calculation at the start of the year was that rapidly rising interest rates would have a big effect on world economy because of the increase in the stock of debt. Now, this is the chart for the US, which multiplies the average of the 5-year yield and the Fed funds rate, so average interest rates, with the national debt to give an estimate of the interest bill. And you'll see it is a massive high. So as debts come to be refinanced, so the interest bill is going to rise rapidly, and all indebted entities will face sharply higher bills. And that, my calculation then, was that would rapidly cool the economy. Now, and that hasn't happened because we know the vast majority of mortgages in the US are 30-year mortgages, which essentially are unaffected by the rise in interest rates. Everything else is. So as corporate bonds come to be refinanced, so companies will face higher interest rate bills. When they will have reduced profitability, they should then attempt to cut costs, which means laying people off. So I fully expect higher interest rates to affect the economy, but the lags are higher than I had been expecting. These are UK 5-year real yields, and they are strongly positive and rising. Interest rates are rising even as inflation comes down, so real yields are rising. That increases the cost of investment and reduces credit flows and should slow the economy. And 3-month US Treasury yields are now higher than equity yields. So why would you own equities when the economic outlook is so uncertain? The only reason to own them is if you believe that the price is going to keep on rising and you will get a capital gain. Once equity prices start to fall, so that becomes less plausible, causing a cascade of selling. Essentially, US equity investors here are invested in a Ponzi scheme. The only reason to hold them is if you believe other people will buy them off you at higher prices. These are UK bond yields, and they have been rising very quickly. The Bank of England has completely lost control of the curve. But when things rise this quickly, they tend to revert very quickly. We don't know when they'll peak, but they will peak because they can't rise forever because they have economic consequences. They will slow the economy and bring inflation down. So this is UK 2-year, not looking great. Been rising very rapidly over the last 2 months. At the beginning of May, it was well below 4%. It is now well above 5%. That is rapid monetary tightening. Not by the Bank of England, by the financial markets. You're taking out a UK mortgage, your mortgage rate has just gone up by 1.5% in 2 months. Not because of the Bank of England, because of the financial markets. It's a UK 10-year, similar story, UK 30-year, back towards its highs. This is the US 10-year, which is also risen, which is rather surprising given we know that US inflation is coming down. Inflation expectations are well anchored. It appears that investors are switching back into equities. These are German bund yields, again risen. Italian, strong rise the last couple of weeks, and Greek, strong rise. Finally, our views, which are unchanged. If you're interested, have a look. And concluding comments, well, it's been an absolutely extraordinary first half of the year in which EU and US equity markets have completely defied rising interest rates, economists' expectations, the central bank's expectations, and my expectations. Can that continue in the second half? The global manufacturing sector is in recession. Global trade is in recession. China is slowing. But labor markets are defying slowing economies in the EU and the UK as companies hoard labor. But we know that interest rates act with a lag and they are still rising. Expect central banks at some stage to create some slack in the labor market and bring inflation under control. In the second half in the US, we know that the negative credit impulse will start to affect the economy, and there is fiscal tightening in the form of student loan repayments, which will affect 27 million Americans. Economic headwinds are rising despite positive economic news that we've reported this week and the resilience of the US economy. I still expect a recession in the second half. So I'm doing this on my own today, so I'm just reporting my performance. Richard should be back as normal. The service resumes this Friday. So last week I had a terrible week the last couple of weeks, I've had a terrible time as UK bond yields have risen. So I'm down 2.1% over that period, and I'm having a terrible year, down 9.4%. Actually, my worst year ever. I did, though, manage to outperform the all-share over the last couple of weeks, although not year to date. Let's hope for a better second half of the year. No buys, no sells. Now let's talk about TR24, which I've been talking about for the last few weeks, and has been defying my predictions and falling in price. So its price has now down below £98. And remember that it matures at 100 on the 22nd of March, 2024. So in 8 months' time. Now, thank you very much to Lloydie Pool for recommending the website Yield Gimp, which will give you the yields on all UK bonds. Now, according to Yield Gimp, the break-even RPI growth rate that is assumed in TR24, i.e. the RPI growth are beyond what has been already reported, is just 1.7% to maturity. So something very odd is going on. We know that the expected path of inflation for RPI shows it slowing to 6.3% by the end of the year. And we have RPI figures up till May. And if we assume that inflation is indeed 6.5% annualized by the end of the year, then we can work out that total RPI you should receive from now until maturity on the 22nd of March 2024 is about 5%. In addition, you will get 1 over 0.98, i.e. another 2% from the share price. All of that should mean that you'll get about 6.8% from holding TR24 to maturity. That's around 8% annualized. So something very odd is going on in the price of short-dated index-linked gilts. It would appear that the market believes that we're going to have some strong negative RPI prints by the end of the year. But if that's true, that implies UK inflation will come down quite quickly, and that should in turn mean that inflation expectations fall, interest rate expectations fall, and bond prices rise. So TR24 is a very good investment at this point. Much better than having 5%, much better than getting 5% on a deposit account on which you have to pay tax. Here, you're going to get the best part of 6.8% tax-free, as most of it will come as a capital gain. But in the short term, its share price continues to fall, which I just find mystifying. At some stage, it has to start trending towards 100. Okay, that's it. It has been a very long one, as we have a lot of data to catch up on. Thank you all for watching. Reminder, next week, Richard should be back. And also, we will be hopefully trialing a new, shorter format. So, hope to see you next week. In the meantime, please do press like and subscribe to the channel. And it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.